So today we're moving on to an additional topic. We want to start looking at taxation. Clearly there are strong links between government and business, and I suppose also governing the economy through taxation, through the burden governments place on the economy, particularly economic transactions from which they generate taxation. So governments provide lots of services, but the issue is that most of those services don't generate a revenue. So in order to fund the services of government, revenue is required. So to pay for social welfare, to pay public sector pay, to pay goods and services, to pay the interest on debt, to pay for capital expenditure, all requires revenue. Some state services, some government services do have fees. So clearly there is some scope to raise revenue there, but the vast majority do not. So in order to fund its expenditure, the government needs taxation. So a tax is an involuntary payment to the government by an individual or firm that does not entitle the payer to a quid pro quo benefit, pound for pound, unit for unit benefit, get something for something. So most occasions when we give money to somebody, we expect and are entitled to something in return. Go to a shop, go purchase a service, you pay the money, you're entitled to the service. When it comes to taxation, you're essentially entitled to nothing in return. The government collects the money and then it chooses what to provide. Whether you benefit from that is another issue entirely. But the government collects the tax. So why is there taxes? Well, one is the reason to finance the production of goods and services by government. So to pay public sector wages and pensions, to pay for social welfare, pay for goods and services, etc. Then the government can begin to use taxation as a sort of a policy instrument, not simply as a blunt tool to try and collect money. One can be to generate funds for redistribution. So this is the objective of the social welfare system, that you collect money from one group of society to pay to another. So in Ireland we have two forms of social welfare. We have sort of tax-funded social welfare through the Department of Social Protection, and we've insurance-funded social welfare through the Social Insurance Fund. And the primary one which tax revenue is needed for is through the Department of Social Protection. The Social Insurance Fund is funded through PRSI, which isn't so much a tax as an insurance contribution. That if you lose your job, you'll get a certain payment for 12 months. That if you become sick and can't go to work, you'll get a certain payment for a period of time. And that once you retire, you'll be entitled to a contributory pension that you'll have paid into an insurance fund and be entitled to a pension. So the insurance-based social welfare is funded through PRSI, or it's hoped it's funded through PRSI. For the last couple of years, the fund has been in deficit, but it's hoped to return to balance in 2012. But the social insurance paid through the Department of Social Protection, that's funded through taxation. So once your insurance, say, expires for unemployment benefit, you can get job seekers benefit for 12 months, not means tested. You're entitled to it for 12 months if you've made sufficient PRSI contributions. Once that is expired, you're entitled to apply for job seekers allowance. And this is funded through the Department of Social Protection. So it's a means tested payment for people who don't have employment and kicks in after your insurance entitlements have ended, which for most people are after 12 months. You also have child benefit. You have the non-contributory pensions, you have disability allowance, which got in the news recently, which all will be funded through the Department of Social Protection. So the social welfare budget required through taxes is about 13 billion, 12 to 13 billion. So that those funds have to be raised somewhere. The government can also use the tax system to alter economic and social behaviour. And whether this is for good or bad is hard to know, but it can change people's behaviour. The people respond to incentives, and you can use the tax system to change people's incentives. So, for example, we reduce taxes in certain areas. So you can pay for health insurance out of your gross pay. So that for most goods and services, you pay for it out of net pay. Your employer pays you a wage, the government takes its tax, and then you have that money left to spend as you see fit. When it comes to health insurance, you get tax relief for it. that you purchase it from your gross pay. So let's say if you're earning 10,000 and the tax rate is 20%, you'd be due to pay €2,000 in tax. Whereas if you pay €2,000 on private health insurance, that's subtracted from the 10 first. So it's 10 minus 8. Then you pay 20% tax on the 8,000, which would be €1,600. So instead of having a 2,000 tax bill and a 2,000 health insurance bill, you have a 2,000 health insurance bill and a €1,600 tax bill. It's cheaper to purchase it when it's tax deductible. So it encourages people, or has encouraged people, to purchase private health insurance. Much the same happens with contributions to pensions. They're tax deductible. That up to a certain limit, a fairly high limit, you can make contributions to a pension fund and not pay income tax on it. The theory being that you'll pay tax once you draw the money down from your pension, although that theory has been tested during the past week or so. Given the issue about taxing pensioners, that the threshold was set at 18,000, but it's turned out that a huge number of pensioners were only revealing their private pension to the revenue commissioners, and that there's a €12,000 state pension as well, which wasn't being revealed. So for many people, that would bring them above the 18,000 threshold, and tax would be liable on that. So you wouldn't have paid the tax as you put the money in, but you are supposed to pay the tax as you put the money out. So this is the tax relief on pensions is supposed to encourage people to save for the future. The fact that you'll be retired for 20, 25 or even 30 years without having a wage, an earned income, to encourage people to save. There are suggestions that it's an inequitable system, that those who benefit are those to earn more in the first place, that you're allowing them to avoid or evade or reduce their tax bill. But it does offer an incentive for people to undertake pension savings. When it comes to taxation, you can try to discourage something as well, and it doesn't take much of a tax to discourage activity. The simplest example being the plastic bag levy. It started off at 12 cents. It's now up somewhere in the 20s, I think 25 cents is it, and is possibly going to be increased to 40 or 45 cents. But that led to a huge reduction in the consumption of plastic bags in Ireland. A reduction at the time of more than 95% when the plastic bag levy was introduced. So it changed behaviour. And there are other areas where taxes are changed to try and make certain activities more or less likely. In the previous government, there were substantial changes to VRT, vehicle registration tax, to try to encourage people to buy greener cars, cars with lower emissions. Although much of that has been scaled back in the recent budget with increases to VRT. But it is using the tax system to try and change behaviour. And I suppose most famously in Ireland, we have the use of the tax system to encourage activity in the construction sector, to encourage the building of holiday homes along the Atlantic seaboard, to encourage the construction of urban car parks, hotels, nursing homes, many of which are useful up to a certain amount, but we tended to go overboard. And of course there also is a tax relief for the provision of student accommodation, as we can visibly see in the area here. So you can change behaviour with the tax system, make one activity less or more desirable. Taxes now all tend to be very much internal. Before the existence of the common market, there was a lot of taxes placed on goods moving in and out of countries. You could use customs duties to try and make imported goods more expensive relative to domestic goods. But once we entered into the EU and with the establishment of the common market, with the Single European Act in 1986, we no longer have customs between EU countries. And then the GATT, the General Agreement on Tariffs and Trade, has seen a substantial reduction in customs and levies across most countries. So now most taxes tend to be internal. And the final reason for taxes is to achieve economic objectives. And our sort of key plank of achieving economic objectives through the tax system is the corporation tax. We want to attract foreign investment into Ireland. We'll claim to have a young, well-educated, flexible, English-speaking, highly motivated, enthusiastic, hard-working workforce. And at the back of it all, we have a 12.5% tax rate. which is primarily what has attracted many of the companies to Ireland. And several studies have been undertaken and looked at why these companies choose Ireland, and the tax rate is one of the key planks of that. And sort of in the ongoing Eurozone crisis, there has been frequent references to the Irish corporation tax, and each and every time the response from Ireland, from both the previous government and the current government, is that the corporation tax rate won't be changed. Whether that will actually be able to be maintained is hard to know, but that is the current policy stance. So they realise the importance of it. It probably wouldn't make much of a difference if the tax rate went from 12.5% to 15%. Is there going to be a mass exodus of foreign investment from Ireland because of a change to 12.5% to 15%? The issue would be the signal it would send. That if they're going to change it from 12 to 15 this year, well, maybe in 2 years it'll go from 15 to 20, and then from 20 to 25, and that it might discourage future investment. So the stance that the corporation tax rate won't change is understandable. But as we saw yesterday, these EU agreements that the leaders come together, that thing we looked at yesterday was only 3 or 4 pages. Yet half of one paragraph was devoted to Ireland's willingness to participate in a discussion about the common consolidated corporate tax base. Now we'll look at corporation tax in more detail when we get through to it. But the common consolidated corporate tax base isn't about getting us to change our tax rate. That's not going to affect the 12.5% rate. What it will change is the tax base, the amount you can tax at that rate. And what the EU want to change is if a company earns profits in Germany, or earns profits in France, or earns profit in England, it pays corporation tax where the profit is earned, not where the business is located. So there's a huge number of businesses located in Ireland. Some would be claimed to have what's called brass plate operations, that all they're doing is channeling the profits through and paying the corporation tax at 12.5% in Ireland when the profit is earned elsewhere, with corporation tax rates of up to 35% and 40% in most EU countries. So the CCCTB isn't about changing the rates, it's about changing what you can tax. It was assumed that most countries had a veto in Europe, that unless everybody agreed, something couldn't proceed. And taxation was one area where there's a veto, and that formed part of the debate for the Lisbon Treaty. Would we have our tax veto? And there was certain provisions written into the treaty for Lisbon 2 that weren't felt maybe to be legally binding, but there is a suggestion that the veto still exists. But of course, before Christmas, the last EU meeting, David Cameron thought he had a veto. He thought he'd be able to stop the fiscal compact that would lead to particular rules being imposed on governments on their fiscal accounts, and also the introduction of a Tobin tax, a tax on financial transactions. Financial transactions are probably one of the few things you can do without encouraging a tax. Buying and selling shares, creating derivatives, buying and selling bonds, there's no tax on that. There's practically nothing you can buy without a tax. So this suggestion is a Tobin tax. So Cameron tried to veto that, but what's ended up happening is that the other 26 countries have gone ahead with it, and he's sort of now skirting on the edge, wondering what will happen. Will he get more support, and if countries come towards him and the numbers grow, or will he get less support and become somewhat isolated? So the issue of the veto is subject to some debate. So if the EU wants to change the CCCTB, do the sort of developments before Christmas mean that now they can just plough ahead and do it? And are we left sort of high and dry? So these are the 4 reasons for taxation: to provide money for the government to spend with the hope that they'll spend it wisely and efficiently, to generate funds for redistribution, sort of Robin Hood mentality, to take from the wealthy and give to the poor, to alter economic and social behaviour, to change incentives, and to achieve economic objectives. The objective being to encourage investment, leading to economic growth. So we'll look at some different types of taxes. So some payments to government are classified as user fees. So the registration charge, or now what's called the student contribution to third level education, would be a user fee. So a benefit tax is an involuntary payment to the government that entitles a taxpayer to a benefit. So for example, the student contribution, there used to be service charges for waste collection, etc. That if you paid this particular charge, you're entitled to a particular service. If you pay the student contribution, you're entitled to third level education. There's also revenue what's collected from what are called hypothecated taxes. And this is earmarked and does not enter the general revenue pool. And we have some hypothecated taxes in Ireland. Most tax revenue goes into the Exchequer account. That's into the Department of Finance. They collect it and they then distribute it amongst the various departments. But there are some taxes that don't enter into the Exchequer account. Motor tax is earmarked for use by the local authorities. It's collected by the local authorities, and they get to hold on to it. And they get to spend it then on maintaining the road infrastructure in their region. The new property tax, or it's not site value tax yet, the new household charge, sorry, we'll call it, is hypothecated. Again, that's collected by the local authorities for the provision of water and other services to houses in the local authority region. And a final hypothecated tax is the TV licence, which goes to RTE. This is all money that the government could collect and put into the common pool, but it's actually earmarked for particular uses. And there are advantages and disadvantages to these hypothecated taxes. That whether they actually achieve the objectives that they're set up to achieve is hard to know. Because with the household service charge, it's likely that all that will happen is that central government will reduce the transfer it makes to local government. So local government in the main is funded through contributions from the Exchequer, but with the local authorities collecting about 160 million from the household charge, it's likely that their grant for 2012 will be 160 million lower, and probably perhaps even lower again. When looking at taxes, taxes can be classified according to who pays them, individuals or businesses. So is it a tax on the individual, such as income tax? Is it a tax on businesses, such as corporation tax, or one paid by businesses, such as VAT? Well, that perhaps might not give a very strong distinction about who actually carries the burden. There's also a distinction between direct and indirect taxes, and this tends to be more frequently used. Direct taxes are on the individual. So income tax is a direct tax. You directly tax the income of the individual. When it comes down to it, all taxes are paid by people. Somebody must pay it. A business might be a distinct legal entity, but businesses don't pay tax. Either the workers of the business pay it, the owners of the business pay it, or the customers of the business pay it. When it boils down to it, a person pays the tax. So this is why taxes are sometimes called indirect. You don't tax an individual, but indirectly an individual will end up paying. So VAT is an indirect tax. It's placed on goods and services, which are goods and services can't do anything. So the debate in the run-up to the last budget was that the government wasn't going to increase direct taxes, income tax wasn't increasing, but as the German Parliament found out, we were going to increase indirect tax, so that the standard rate of VAT increased from 21 to 23%. And that's a rate on particular goods and services. But it's an indirect tax because it's people that will pay it. And sometimes it can be difficult to work out who actually pays it. When the VAT rate increases, is it the supplier who pays? So if you go to Lidl, you'll see Lidl have fairly substantial posters up saying that their prices didn't change from the 31st of December to the 1st of January. On the goods that they sell that attracted the standard rate of VAT, they have absorbed the VAT increase. The prices remained exactly the same. So Lidl and Lidl's owners are carrying the tax there, or perhaps even Lidl suppliers. Maybe they force their suppliers to drive down their price to keep the price to the customer the same. Whereas for other goods and services, the price will rise by the 2% and be passed on to the consumer. So determining who bears the burden of the tax will come to, and it can be quite difficult. With VAT, there are various claims as to who actually carries the tax. Is it the customer? Is it the supplier? Is it the business? Is it the worker? So direct taxes are levied on people. Indirect taxes are levied on goods and services, but people pay them. Goods and services can't pay taxes. Another difference is the tax base. This is the amount of money that's taxable, as we refer to with the corporation tax. So the tax base of a direct tax usually includes the amount of the tax. So a tax inclusive base. So if you were paying income tax, so in the example we gave at the start, if you have an income of 10,000 and the tax rate is 20%, the 20% is calculated off the 10,000. Everything is included, and then the tax is calculated off that. So the 10,000 then becomes 8,000 net pay and 2,000 tax. The total remains the same. It's a tax inclusive base. The base is 10,000, the tax is subtracted from that, and you divide the money then into two parts. The part you get to keep, your net income, and the part on which you pay tax. Whereas the tax base of an indirect tax usually excludes the amount of the tax. It's a tax exclusive base. If a product is sold by a shop at 100 and it's liable for the standard rate of tax at 23%, 23 euro is added on. The price to the customer becomes 123. So the shop is selling it for 100 and the 23% tax is added on. So the base is 100 and the tax increases that and you get up to 123. Whereas for income tax, the base would be 100 and you get back to 80 once the tax is subtracted. So there are differences to what the tax is applied to. So a tax inclusive base and a tax exclusive base. We can also break taxes down to economic activity. So you must do something to pay taxes. Earn money, spend money, invest money, get money, whatever it is. It generally involves the exchange of money. But there are lump sum taxes which have nothing to do with transactions. So a lump sum tax is a fixed amount of money that must be paid regardless of circumstances. So there's no incentive to change economic behaviour to alter the amount of the tax. So sometimes these are called poll taxes. Margaret Thatcher in the UK in the 1980s tried to introduce a poll tax, a tax per person. From an economic perspective, poll taxes are hugely efficient. They are perhaps one of the most efficient forms of taxation because they don't change behaviour. It's not making something more or less expensive. It's not changing relative prices. It's not influencing behaviour. So in terms of changing economic activity, a poll tax is hugely efficient. The issue is that on counter to that, a poll tax is hugely inequitable. Everybody pays the same, regardless of circumstances. So regardless of your income or your wealth, a poll tax imposes the same financial burden on everybody. But clearly the real burden could be far different. So this is one of the arguments against the household charge. It's a flat charge of 100 euro. Regardless of your economic circumstances, you pay 100 euro. Regardless of the size of the house, the location of the house, the amount of services you use, you pay 100 euro. We're told it's just a temporary measure, that a site value tax will be imposed over the next 2 years, which it's hoped will better reflect the circumstances of the individual, that those with bigger houses will have bigger and more valuable sites, and they will pay a higher amount. But the charge that it is at the moment is very efficient. There's nothing you can do to avoid the tax, and it won't change where people will buy a house, it won't change where people will put a site down, it won't change where people would influence the size of the site, because it's 100 euro regardless. When the site value tax comes in, that might change behaviour. And in this instance, the site value tax would be more equitable. You'll pay more if you have more, but it mightn't be more efficient. It might lead to change in behaviour and lead to an inefficient outcome. So the lump sum tax is efficient, but hugely inequitable. Then you have taxes when you earn money. Taxes on income are called factor taxes. So there's 4 factors of production: land, labour, capital, enterprise. And they all earn an income. So the factors of production are land, labour, capital, and enterprise. So land earns a rent. Capital earns interest. Labour earns wages. And enterprise earns profits. All of those are taxed. So regardless of where your income comes from, they'll all be taxed. Most under income tax law. So there's different taxes for different sources of earnings. So you've got just plain income tax. If you get money, you pay income tax on it. You've DIRT, deposit interest retention tax. If you have money in the bank, capital, and earn interest on that, you pay DIRT. Income tax is liable on rental income. And then if you have a business that earns a profit, you're liable to pay tax on the profit you take from that business. So these are called factor taxes because they're on the factors of production. So land, labour, capital, enterprise. Then there are taxes placed on goods and services. And these can take several forms. There can be just a plain retail sales tax, which we don't have in Ireland. But many countries, particularly the US, has a retail sales tax, where a tax is applied at the point of sale. If you go to a shop and see an item for sale, particularly in the US, it generally won't have taxes included, particularly state taxes, or maybe even some local taxes. You'll have to add the tax on. So it's a tax at point of sale of a certain percentage, 5, 7, 10%, whatever it might be. And retail sales taxes tend to be general, applied to everything. Alongside retail taxes are excise taxes, and we have these in Ireland. An excise tax is a sales tax that's levied on a particular product. So it's on a particular good. So some of the main excise taxes in Ireland are excise taxes on alcohol, cigarettes, fuel. There was supposed to be a betting tax, I think that's been abolished since, or else it's quite small. Cigarettes, alcohol, fuel would be the main excise taxes in Ireland. So they're levied on particular goods and services. In Ireland we don't have a sales tax, but we do have a VAT, a value added tax. This differs from a sales tax because it's levied at every point of production. As the product passes from firm to firm, VAT is levied, and it's levied on the value added. So if I'm at an early stage of the production process and I buy a raw material from a supplier for 100, if that's liable at the 23% rate, 23 is added to that. So I pay 123. If I then get that and sell it for 150, the increase in value there is 50, from 100 to 150. So VAT is paid on that, but I can claim back some of the VAT I paid in the earlier stage. Once you get to studying tax law, you'll figure out how complicated it is. So VAT is added and we get to 150, and VAT is added onto that, we get to the next price. Then it keeps getting to the consumer, and eventually you get to the consumer with the final price. So VAT is added at each stage. The jumps aren't as significant as that because you can claim back previously paid VAT and you can offset VAT, but it is added at every stage. So it's a requirement that every company pay VAT. With a retail sales tax, you're only getting it from the retailers. With a VAT, you're getting it at every stage, and the kind of objective is to increase a paper trail, that if you can track and trace particular transactions through a large number of firms, you have a better chance of figuring out what's going on. If you don't have a VAT, the only thing you see is what happens at the end. Well, what happened at all the intermediate stages? Who was taking what, who was charging what, who was earning what? So the VAT creates that paper trail, and that's one of the reasons why there does create a huge amount of administration, but then it's primarily because of the administration that it's created. So most companies have to be VAT registered. So it tells the government that the company is out there. Well, I suppose it tells the revenue that the company is out there. So VAT is on most goods and services. So in Ireland, under EU law, you're supposed to have 3 rates of VAT. And up to last June, we did have 3 rates of VAT. There's 0%, which would be on necessities, basic foodstuffs, children's clothes, etc., are all levied at the 0% VAT. VAT isn't added. There isn't an amount added. There's the 13.5% VAT rate, which is called the lower rate of VAT. And then there's the standard rate, which now has gone to 23%. So I presume to try and ease, I suppose, the complication of a VAT system, you're limited to 3. But in May, we got a dispensation to introduce a temporary 4th rate. So there was a jobs initiative last May, and the tax on leisure activities, on restaurants, on pubs, on tourist areas, was reduced from 13.5% to 9%. It's a temporary measure due to expire in 2014, but I suppose try to stimulate some activity in the leisure and tourist sector. VAT was reduced from 13.5% to 9%. So now we have 4 rates of VAT, although the 9% is just called a special lower or a temporary lower. Technically it's not 13.5 and 23. Then, as we said, there are customs and import duties, but they tend to be almost obsolete in an Irish case now. We do collect some customs duties. We'll look at Irish tax revenue in a minute, but the customs duty that we collect is for the EU. We can't levy customs duties on other countries, but the EU as a whole levies some customs duty on goods coming into the EU, and it's collected by the country into which the goods come. So we do collect some customs duty, although it's quite a small amount. I'm not quite sure actually where the money goes, but it doesn't add up to a huge amount. There are some specific taxes. So there's a partial factor tax, which is a selective income tax levied on the income of a particular factor employed for a particular use. So corporation tax is a partial factor tax, because the tax applies only to the earnings of shareholder capital, a particular factor, employed by incorporated firms, a particular use. So we could wait to collect the tax earned by shareholders in income tax. We tax all income. Why not wait until shareholders who own companies take the money out and then tax their income? Well, we'll look at the corporation tax in more detail, but there are a number of reasons why you would tax corporate profits. One reason is the shareholders mightn't live here. We might have a 12.5% tax rate, but if we left it to the shareholders until the tax is taken, well, we collect very little at all, because all the foreign multinationals aren't owned or based in Ireland. They just have operations here. If it was the shareholders paying the tax, well, the money would leave Ireland and we'd never collect it. And then there are special rights and privileges given to corporations. They get the benefit of a young, eager, English-speaking, hard-working workforce that somebody has to pay for. Plus, there's the benefits of being a corporation, of having limited liability, that shareholders are only liable for the losses of the company, and the only money that can be taken off the shareholders is the money they put in. So if you invest 100,000 in a company, and that company loses a million, so if you invest 100,000 and that company loses $1 million, all you can lose is 100,000. You have limited liability. So take the shareholders in the banks in Ireland. They own them. These banks have generated huge losses. Might sound strange, but all the shareholders have lost is the money they've put in. They weren't liable for any of the additional losses. That once their shareholder equity got to zero, that was it. They couldn't be chased or anything else. You couldn't go to an AGM and pass around a collection box and say, lads, we have a bit of a shortfall here, and try to fill it up. So there was about 100 billion of a shortfall, or losses, sorry, in the Irish banks. The shareholders probably covered about 25 billion. There was probably 25 billion of shareholder equity in the banks. And once that was exhausted, you had to go somewhere else. So the government has turned to subordinated bondholders. They're sort of next in the food chain. They don't own the company, but they are getting a higher rate of return for additional risk. And they contributed about 15 billion. But again, they were only liable for a certain amount of the money they put in, whereas the shareholders got zero. Whatever money they put in, they've got nothing back. Shares in AIB, Bank of Ireland, trading at €20. Shares of AIB are gone, they're at zero. And shares of Bank of Ireland are at 8 cents. So you can work out the percentage drop from €20 to 8 cents. And the ownership has been diluted. So at €20 you had a certain amount of the company. At 8 cents the amount of the company you got is even smaller. So they've been completely wiped out. The subordinated bondholders have probably got 20 to 40% of their money back. So for every 100 they put in, they got 20 to 40 euro back. But they have been stung for 60 to 80 euro. So that gives us 25 billion from the shareholders, 15 billion from the subordinated bondholders. So the total losses were 100. We need another 60, and that's where the state stepped in. So the state, the exchequer, has provided the remaining 60. So this sort of insulation from losses is one reason why you tax corporations. That we have collected tax from the banks over the last 10, 15 years, nowhere near enough to cover the amount of losses. But if we left it to the shareholders, many of the shareholders of the banks wouldn't live in the country. We'd have collected nothing from them. So by collecting the corporation tax, at least we got some bit of a contribution. So there are many reasons why you'd have a specific tax like this and not just leave it to income tax to pick up what's flowing through. So there are other selective taxes, such as capital gains tax when you sell an asset. There's also capital acquisitions tax when you get an asset. Either somebody gives it to you and says, look, here's a present, you have to pay capital acquisitions tax on that, or primarily it's through inheritance. If somebody dies and leaves an estate, capital acquisitions tax is due on that. There's an estate or inheritance tax. There are property taxes. So we had a residential property tax in Ireland in the mid-1990s. It was abolished. We're supposed to be getting back towards a variety of a property tax. And then there's stamp duty, which is on certain transactions. So to have a transaction made official, you must get it stamped. So the government could just let transactions go and register them, but for the registration you have to pay a stamp duty. I'd imagine this tax has expanded in its role over time. It probably was just to cover administration costs in particular offices, but did become a substantial revenue earner. So in Ireland, the most prominent stamp duty was in the purchase of homes. To get a conveyance approved, it had to be stamped. And the cost of the stamp was based on the value of the house. And this is particularly true for second-hand houses. There was limited or no stamp duty on new houses, one reason being that there isn't a change of ownership. It's just been bought for the first time. When it comes to the second-hand market, you're going from one owner to another. So we did have substantial stamp duty that brought in huge revenues for the state. 3 to 4 billion per annum was brought in stamp duty, and most of that was from property. There are other stamp duties. There's a stamp duty on shares in Ireland. You have to pay a 1% tax on buying shares. Most countries don't have that. There's a stamp duty on insurance contracts. And although last May's Jobs Initiative reduced VAT on certain goods and services, we have a stamp duty on pension funds. There's a 0.6% levy or stamp duty on pension funds. I'm not quite sure what you get stamped. But if you have a private pension, 0.6% of the assets for each of the next 4 years are liable to this stamp duty. The selective excise taxes we've gone through, the so-called sin taxes, the old reliables, cigarettes, alcohol and fuel. With excise taxes, the rate of some excise taxes is fixed in euro per unit of the good. In fact, most excise taxes in Ireland are what are called ad rem, per unit. So the minister puts a certain amount on a pack of cigarettes, 50 cents on a pack of 20, puts a certain amount on a litre of petrol, 5 cents on a litre of petrol, or a certain amount on a pint of beer, 5, 10 cents on a pint of beer, whatever it might be. It's per unit. For every unit sold, a fixed amount of tax is due. There can be other excise duties which are ad valorem, per value. So you could say the excise duty is increasing from 10% to 20%. The excise duty on betting, not quite sure whether it still exists, is ad valorem. I think at one stage there was a 10% betting levy. If you went in to put was it 5%? That 10% sounds excessive. We'll say a 5% betting levy, I'm not quite sure. If you went in to put a bet of €10 down, you actually had to hand €10.50 over the counter. €10 for your bet and 50 cents in tax. The betting levy has been reduced, I think maybe down to 1%, or perhaps doesn't even exist anymore. I'm not so sure. But it was per value. So it wasn't a fixed amount per bet, it was based on the value. And that is an excise duty. Perhaps we can look that one up. Principles of taxation we'll come back to. So how much do we collect across these various tax headings? So here's tax revenue in Ireland for the last 2 years. So it's collected under the main headings we've gone through. You have income tax, VAT, corporation tax, excise duty, stamp duty, CGT, CAT, and customs duty. Again, I said the customs duty is an EU tax. We generally don't impose customs duties, but it is the smallest of them there, although not by a huge amount. So you can see the rates collected. So this year in Ireland, tax revenue is 34,000 million. This is exchequer tax revenue. Some of the hypothecated or earmarked taxes we suggested aren't in this total. So there's about 1 billion collected in motor tax. That doesn't appear here. There's about 160 million from the TV licence. That doesn't appear here. And for 2012, there'll be about 160 million from the household charge. That won't appear here. So this is exchequer tax revenue, up to 34 billion. In 2007, it was 47 billion under these headings here. It dropped to about 31 billion. So you can see 2010, 31 billion, 700 million. So it dropped by about a third in the space of a couple of years. And last year it began to increase. Some of the increases aren't maybe as real as it might say. That does suggest that tax revenue is quite buoyant. So that's an increase of 7% on the year. Some of the issues are because of reclassifications. There was a hypothecated tax that was put into income tax. So in 2010, there was a health levy on income. So it was at certain percentages, 2%, 4%, 6%, depending on your income, but it didn't go into the general pool. The health levy was hypothecated for the Department of Health. They got that money, and they got to spend it on healthcare services. And that raised about 2 billion, the health levy in 2010. So that 2 billion wasn't in income tax. In 2011, the health levy was abolished. So the minister said, look, rather than having this health levy going to the Department of Health, and there also was a separate income levy that was paid into the exchequer, Brian Lennon in his last budget introduced the universal social charge, which gets a very bad rap because of the size of it. But what tends to get omitted was that the universal social charge replaced the health levy and the income levy. So somebody would say, I'm paying €200 a month and the universal social charge are crippling me. Well, the likelihood is that close to €200 a month in other taxes were reduced. But again, the balance of the debate doesn't tend to go in that direction. So part of the reason for the huge increase of 22% in income tax isn't that we suddenly started earning more or paying much more income tax. It's just a reclassification from 11 billion close to 14 billion. So that explains most of the increase. So tax in Ireland in 2011 was largely flat. Might have been a slight uptick, but largely flat. You can see VAT has fallen. So fallen down to under 10 billion. VAT a couple of years ago was approaching 14 billion. A lot of that was coming from the construction sector. If you're putting VAT on a house for 200,000 and all the intermediate goods that go into the construction of the house, you can imagine a substantial amount of VAT would be paid. We were building close to 90,000 houses a year in 2006. So a lot of the drop in VAT is because of the complete stalling of the construction market. But in 2011 it continued to fall. So there are some arguments of why are you increasing the rate on a tax which is falling? Activity is falling, so are you going to stimulate activity by increasing the tax? But we've gone from 21 to 23. Corporation tax, 3.5 billion. This was 6 billion at the peak. So it has fallen by a significant amount as profits have fallen. I don't have the figures in my head, but I imagine there'd have been a good drop because of the profits of the banks. AIB, Bank of Ireland, Anglo would have been earning profits of in excess of $1 billion a year. So we could have been collecting 400 or 500 million corporation tax from those banks in the good days. Now they're a complete drain on our resources. And there are also issues about the multinationals. The amount of money they channel through the country and the amount of tax we actually get to collect. Are they here for the tax rate, or is it just to use our tax law? Are they engaged in things like the double Irish, where they move profits from Ireland to Amsterdam to Bermuda and get the money back into the US without paying any tax at all? So even though Google is in Ireland, Google has a revenue in Ireland of about 11 billion. I'd imagine that Google makes substantial profit in that 11 billion, particularly in Ireland when it has just over 2,000 staff. So regardless of what it's paying them, it's not spending close to 11 billion in the Irish economy. But Google paid corporation tax in Ireland of 130 million. So revenue 11 billion, corporation tax 130 million. That is just over 1% of revenue. I'm not quite sure what their profits are, but it does suggest that their profit rate in Ireland is quite low. They are channeling most of the money out, and there are suggestions that it goes into Bermuda, and that the shareholders who are largely in the US can then get the money back from Bermuda and actually pay no tax in it, have neither corporation tax paid in it, and then just be liable for certain income taxes in the US. But because of double tax treaties, they can claim to have been taxed elsewhere, and their tax bill is reduced. It's what every good company should do, but perhaps we should look into it. Excise duty has fallen, but not by a huge amount. That was at a peak of about 6 billion. Amazingly, it was the same in both 2010 and 2011. No change. Stamp duty fell from 4 billion a year down to 1 billion, a drop of 75%. The economy is contracted by about 15%. Stamp duty is down 75%. A complete collapse in revenue, driven primarily by the collapse in the construction market. In 2011, it did increase, but it isn't because we weren't engaged in any more transactions. This was because of the pension levy introduced in May, the 0.6% pension levy, that brought in just under 500 million. So in fact, if you took the 500 million out, you'd see that stamp duty was also down. But there is about 90 or 95 billion of funds held by Irish people in private pension funds, and the government took 0.6% of that and will do so over the next 3 years, looking to raise about 2 billion. The other taxes also have collapsed. Capital gains tax was a huge earner for the state when people were selling houses. We don't charge tax on your principal primary residence. That's a huge tax relief that cost the government billions throughout the good times. That if you sold your own home, you paid no tax. If it was a second home or a home you didn't live in, you did pay CJT, and billions were collected on that at a rate of 20%. CGT used to be 40%, but Charlie McCreevy reduced it to 20%. I think it's now back up to around 27% in the last budget. So it has increased from 20 to 27, but the issue is there's no profits out there. There's nobody selling assets, and if they're selling assets, they're not selling them at a profit. And if you have made losses, you can use previous losses to offset current gains. So if people have sold assets at losses over the last number of years, they won't start paying or be liable for CGT until they get back to selling assets at a profit above what they've lost. And this is the same for corporation tax. If a business makes a loss in 1 year, it can then use that loss to offset its tax in subsequent years. So we might say we own the banks, they'll start earning a profit again, but they're unlikely to start paying corporation tax anytime soon. Particularly the banks we don't own. We've seen Ulster Bank in the news during the week with about 900 job losses throughout the island. They've had huge losses in Ireland. They may return to profitability, but it could be a long time before they start paying corporation tax. With AIB, Bank of Ireland, Permanent TSB, it doesn't really matter. We're the shareholder. If they earn a profit and don't pay a tax on it, we're going to get it anyway. Capital acquisition tax is when you get an asset. This hasn't been affected hugely by reduction in the number of people dying. People are still dying. The issue is the value of the estates they're leaving. 2006, you had house prices of X. Now they are 40, 50, 60% below that. So the value of the estate is substantially lower. And as I said, customs duty is largely an EU tax that we just collect, but it's only a tiny amount of the proportion. So I'll leave that with taxation for today. I will take it up with Adam Smith next Thursday.